First of all, thank you everyone for joining us today. My name is Allie Johnson and I will be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Justin Lewis, who is a Community Economic Development Operations and Program Manager with People, Inc. He'll introduce himself and take us through a presentation on credit building for small businesses. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them at the end of our session. For any questions that we can't respond to during this webinar, we're happy to address them through our no-cost one-on-one services or connect you to resources that can help. We'll share a recording of this webinar as part of our follow-up email. So, what is Capital Pathways program? The Capital Pathways program is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Businesses and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start with the overview of the program, then go through the program eligibility, and finish up with an outline of the services we offer. So, Capital Pathways is a no-cost, specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Being capital ready matters because businesses that are less prepared can often self-select out or fail on loan applications. Early failures correlate to a lack of adequate capital, and higher cost alternatives don't build long-term capacity. Ultimately, only about half of the loan amounts requested reach small businesses. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only about 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses and nonprofits at any stage who face finances accessing traditional financing are eligible for our program. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit advising. We start our process with a self-assessment that pinpoints your business's key gaps so we can connect you with the tailored resources, either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm which can help with more complex topics related to business registration, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. Our loan application readiness services include both webinars and one-on-one individualized support. These webinars cover topics such as what lenders look for in a loan application, interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender that provides one-on-one support to those looking for capital. Finally, our new credit building advisor will help you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for better financing options and terms. So if you're interested in these services getting started, you can reach out through our website at virginiasbdc.com/programs/capital-pathways. Or you can reach out to me directly at ajohn216 gmu.edu. I'll share my email and our website link in the chat for all of you to have. Now over to our introductions. As mentioned before, my name is Allie Johnson, and I'm today's moderator and serve as the program and intake coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects, both domestically and internationally. Today's session will consist of a 60-minute presentation. And again, please feel free to ask questions throughout the presentation using the Q&A function. We'll respond to them at the end of our session, and any questions that we can't respond to, we're happy to address through our no-cost one-on-one services or connect you to resources that can help. As I mentioned before, we'll share a recording of this webinar in a follow-up email. So now I'll pass the mic over to Justin to introduce himself, tell us a bit about his background, and start his presentation.
Hi, thank you so much, Allie, for having me. I'm very proud and excited to be here and to work with Virginia SBDC yet again. They've been great partners all along. My name is Justin Lewis. I'm the Operations and Program Manager for Community Economic Development at what's called a CDFI. I'll talk a bit about what that is here in a minute. That's a Community Development Financial Institution. We are called PIFS, People Inc. Financial Services. We are headquartered in Abingdon, Virginia, which is in the far southwest Virginia, almost down to the Tennessee line, but we serve about 40 counties in the state of Virginia. So today's session, I'm going to jump right in because we have a lot to cover, and I want to make sure I leave a little bit of time at the end for questions. So I call this Credit That Works. It is about establishing small business credit, especially on that micro enterprise level. That's most of the businesses we're working with, and a lot of folks who are seeking counseling. Not to say that there aren't larger small businesses that also need capital, but that's a little bit of a different phase. So what we're going to do is we're going to explore what credit is, how it works, how to build and maintain it wisely, and notably how your personal and your business credit intersect. That's the important distinction here. So everything in this training today was developed by PIFS as part of our community economic development efforts. I am a certified credit counselor with experience helping individuals transition from personal finance into entrepreneurship, and it's designed to be practical, relevant, and easy to apply. These are questions we all have. As Ali said, please put your questions in the Q&A and we'll get to as many as we can at the end of the session. So I said we are CDFI, a Community Development Financial Institution. That is a network of independent, largely nonprofits, but some banks as well, that administer funds in order to serve underserved communities in the financial sector, folks who don't have access to capital through the traditional lanes. And each CDFI is an independent organization, so they all have their own missions and their own policies, and PIFS is one of those. Our goal is to provide affordable, responsible capital, as well as financial education and technical assistance, like this training we're doing right now, in order to support financial stability and community growth. Some of our outcomes from our most recent fiscal year is we administered almost $2 million in business loans right here in our community. That's a number we're very proud of because that is capital that is redirected directly into our community at the community level. So there's a lot of impact. We also have a personal lending program and then tens of thousands of hours of technical assistance over our last fiscal year. I mentioned we serve 40 counties. 24 of them are down in Southwest Virginia, and the other 16 are up in the Northern Shenandoah Valley and Central Piedmont. Our service area reaches a bit beyond that. There's some flexibility there depending on who the loan fund is, but that's the core of our service area. So a disclaimer before we start any training. First things first, this is for education purposes only. This is not financial or legal advice. I am not licensed to give financial or legal advice. If you have specific questions about your situation, go talk to a legal or financial advisor. Also, any choice you make regarding your financial or legal situation when you walk out of this training, that's entirely up to you. Also, the perspectives in this, the opinions, the conclusions, the things I'm about to say are my opinions and conclusions. They don't reflect the organization I work for in its entirety. And then obviously, all of this information is subject to change. It could change tomorrow. So today, the angle we're going to take on this subject is we're going to start with a baseline of personal credit scoring and reporting because that's the baseline to then understand business credit scoring and reporting. And then notably how they intersect. How do they talk to each other? How are they different? How are they the same? We'll talk a little bit about business credit products, largely in shape. I don't endorse any particular credit product on the personal or business side. So we'll talk about the kind of general structure of those products, and then how to prepare when you are ready to go out there and start looking at business credit for your small business. So the first question always is why? Why is credit important? And on the personal side, I think a lot of us have experience with that. We might need to pay for college, make a major purchase like buying a home, buying cars, equipment, things like that. We notably may want to start or grow our business. We may need to borrow $50,000 to put into our food truck. It also affects things like our insurance rates, our security deposits. So it has impact across our professional and personal lives that are more than just borrowing money. On the business side, though, it might be important that we need capital in order to invest in and grow our business. There's typically a time, if your business is on an upward trajectory, there will be a time where you will need to infuse capital. It has to come from somewhere, and we can't always all come from the hip, as my lending colleagues like to say. Credit also helps our business weather the ups and downs. It can also be a tool for managing cash flow. So it's not about borrowing big sums and repaying big sums or making big investments, but more about smoothing out our cash flow cycle. We may also need it in order to win bigger bids, bigger contracts, attract investors. We would need to manage that debt in order to grow our business in that way. At the bottom line, credit is a tool. It helps you grow if applied at the right time, in the right amounts. Too often we see that small business owners are skittish to invest in their business. And understandably, you always want to be conservative in your approach to these things. But if done patiently and strategically, there will be a right time to invest. So let's kind of put a marker down, a benchmark right here about how do personal and business intersect. Notably, your business credit starts at your personal credit, especially for micro enterprise. So that's 2 to 3 people in a business. You work for yourself or you and a partner. Your personal credit and your business credit when you first start out are going to be basically indistinguishable because your business has no track record yet. Which means that in order to work on your business credit right now, something that everybody on this training can do right now is start working on your personal credit because it will be the stepping stone to the business credit. Your consumer reports are the details of your credit history. We'll talk about what that means. And your commercial report are summaries. So they're structured differently, and we'll talk about some of those differences. Ultimately, your credit history tells a credit story, and data matters. The facts and figure matter always. But if you have a coherent narrative for why things look the way they do, that'll always support your proposal. So just because you have maybe a challenged credit history, that's not the end of the road. If part of that credit story is, hey, I was navigating a medical crisis, or I was trying to navigate some predatory lending. Those things all contribute to your credit story, and that can help you build your credit and rehabilitate your credit over time. So let's look at personal credit reporting specifically. So what is a credit report? We hear that term all the time. So it's the details of your credit history as it's reported by the lender. So specifically as reported by the lender, it's not some universal truth. There's not one big database about here's your credit history. It can look like that, but that's not exactly how it works. It's how is it reported by the lender. It tells us the type of credit it is. So is it revolving? Is it installment? Is it a student loan? Is it an auto loan, mortgage, things like that? How long it's been opened, and whether those bills are paid on time. So going back 2 years, 24 months of repayment history. So when a creditor, including folks like us who are an alternative lender of sorts, we can see those ups and downs. Oh, this person is consistent, they pay on time, and then they had this one blip, or this person pays consistently all the time, or this person's up and down from month to month. That's all demonstrated on your credit report. The personal information that's on that credit report starts with your personal identification information. So that's your social security number, your date of birth, addresses you've been associated with. It's also your account history. So the creditor, your payment history, the balance. If it's a credit card, oftentimes the credit limit. So it's your specific account history. It shows any public records, meaning what's in the public record. Since 2018, it is only bankruptcies. It is no longer tax liens, judgments, child support, unless those things are delinquencies. If you have delinquent child support that's been collected on, that'll show up as a delinquency, but it won't show up in the public record. Only bankruptcies on your personal report. And then finally, your inquiries. So how often have you applied for credit? There are two kinds of inquiries. There are your hard inquiries and your soft inquiries. Hard inquiries are when you applied for credit. You signed on the bottom line, you entered into that website, and you said, I'm applying for this. They went in there and they did what's called a hard pull. A soft is for information purposes. It's consumer disclosures. An existing creditor might pull your credit to review in order to upgrade and downgrade their lending portfolio. The hard inquiries affect your credit score. The soft inquiries do not. They are purely for informational purposes. So when you go to obtain a report, and again, we're talking about personal here, the reasons you might want to do that are you are applying for jobs, you're undergoing a career change, you're relocating, you're moving, you're going to have to try to sign a lease or a mortgage somewhere, you're making a major purchase, a home, a vehicle. You're going through a divorce or a separation. You're trying to untangle your finances from a significant other. You might be trying to ward off or prevent or recover from some identity theft. You may just want to set some goals. You want to, okay, I want to invest in my business in 2 years. And so I want to set some goals. I want to, maybe I have a challenged credit history and I want to improve that over the next 24 months for when I do want to invest in my business. That is a perfectly legitimate reason to want to review your report. But these all fall under one basic category, and it's someone else is going to be looking at them. So anytime somebody else is going to be reviewing your report, you want to look at it before them. The last person that you want to be surprised by what's on your report is you. You should always know before anybody else is going to know. So anytime someone else is going to be reviewing it, you should go in and review it first. And where do I do that? You are entitled by law, by federal law, to one soft report, which means no consequence. It doesn't account as a hard application. There's no impact to your credit score. One soft report from each of the three bureaus every 12 months. So once a year, you should go into each of the three bureaus and pull a report from each to review, just for review purposes. The official website that you go to do that is annualcreditreport.com. There's not another one. That is the sanctioned site. It's the only official one. Beware of imitators. That is totally free. Should not charge you a fee of any kind. And I mentioned there are three credit bureaus. It's important to keep in mind that your report will vary between the bureaus. Those three bureaus are Experian, TransUnion, and Equifax. Now, the reason those reports vary is because they each have different subscribers. So different subscribers are reporting different info to those bureaus. Not all creditors report regularly or the same. They may not report consistent on-time payments. They may only report when there's a default. When you go in there, you will have to pull a report from each of the three to review, because there may be something that appears on this one that doesn't appear on that one. And then report and resolve all errors. Even if it's a simple error, like your name is spelled wrong, your social security number is off by a digit, there are duplicate accounts on there, there are mistakes. You do that through what's called a dispute on that bureau, and you go and you say that this information is inaccurate or untrue. And they are required by law to investigate it and determine whether it's accurate or not. And you want to do that because it helps prevent errors in the future, confusion. It also helps ward off identity theft, because that's how a lot of credit fraud works, is they attach phony information to your account, they let it sit there, they let it go unnoticed, and then using your personal data, they apply for credit and run those credit limits up. So dispute all errors. So on the personal side, the ideal candidate, and this is, nobody's perfect. This is just this is the high watermark. This is the ideal candidate, is going to have 3 to 4 revolving accounts. So that's things like credit cards, lines of credit, a revolving account. It goes up and goes down. That has really high limits and really low balances. They want to see you have a lot of credit that you don't need. That's what they're looking for. That's a good sign. They want to see you on the credit card side have a stricter credit card, something like a travel and entertainment card, where the rules for that credit card are a lot stricter. They're not as easy to get. That's why they want to see those high quality credit cards. They want to see all of your trade lines. So that's every bit of credit you have on your credit report. They want to see them be as old as possible, at least 6 months old, but ideally as 3 years or older. They want to see you manage credit over a long period of time. That's what they're looking for. No derogatory items of any kind. No late payments, no collections, no charge-offs, nothing like that. Few inquiries. This doesn't mean no inquiries. Everybody has to apply for credit sometimes, but a couple times a year is fine. And even in batches, you're going out, you're shopping for an auto loan over a couple of weeks, 14 days specifically, that's not pulled out of the air. You apply at a couple different places to try to get the best price. That's actually a good sign. It means you're navigating that credit system intelligently and trying to get the best price for you. So what you don't want to do is go out every month and apply for credit. Those start to stack up, and that starts to make you look credit hungry. And then finally, at least one installment trade line. Installment meaning you pay equal installments over time. So your mortgage, your auto loan, your student loans, they want to see you make consistent payments over time. Only credit cards, only revolving accounts doesn't demonstrate that you will make consistent payments. And the best indicator of future performance is past performance. Great. So, and then how do they score that? How do they take that data and turn it into a personal credit score? So your personal credit score is the calculated risk of lending you money expressed as a numerical value. So they're trying to say, how likely are you to repay, expressed as a number. On the personal side, that number ranges from 300 to 850. So and the higher the better, so to speak. The industry standard is called FICO. That's Fair Isaac's company. You'll hear that in commercials and things. This FICO score. They do have a competitor that's much younger, but also very popular, called Vantage Score. They calculate their scores a little bit differently, but the underlying principles are the same. So everything we talk about here is from the perspective of FICO, but it applies to Vantage. They just score it a little bit differently. Now, the important thing to remember about a credit score is that it is a snapshot of your credit worthiness in this moment. So your score changes over time. As the data that's going into it changes, your score changes to reflect that. It also changes based off of what kind of credit you're applying for. So you go down to ABC Auto Lot and try to get an auto loan from them today. That's going to be calculated differently. That formula, that underlying formula is going to be different than when you go to apply for a mortgage because they're different kinds of credit. So they're going to score those differently. So there's no one definitive credit score. There is that credit score in that moment for that product. Now, what goes into a FICO score? How do they weight this? So they have all that data from your credit report. What are they trying to figure out? So the biggest part, the most important part, 35% of the score is that payment history. I already said it, but the best indicator of future performance is past performance. Right behind that, 30% is how much do you owe? So, and they're looking at balances relative to your credit limit. So I actually see this answers one of the questions in the Q&A is there's this principle called credit utilization. So how much credit do you have access to and how much of it are you using? So they never want to see you use more than 30% of your total available credit. Over 30% starts to become a risk factor. So below 30, you're great. And so let's say you have $10,000 in global available credit. That means it's between a few different credit cards. Let's say you have 3 different credit cards and those add up to $10,000. At no time would you ever be using more than $3,000 of that, 30%. So that's credit utilization. So, but that also expands into much bigger amounts. So do you have a huge mortgage? Owing $200,000 on a mortgage factors in. How much do you have on your installment balances? Your student loans, that's a big one. A lot of times when folks are in for small businesses, they have a student loan balance hanging over their head. And then next behind that is how long you've had credit. So the length of your credit history. So they, like I said earlier, they want to see you have credit for a long time. They want to see you manage it over a period of time. And then the smallest factors are credit mix. So do you have a variety of credit? Have you managed revolving as well as installment, a mortgage, an auto? Best practice here is don't take out unnecessary debt just to improve your mix. It's a pretty small factor all told, but over time, organically letting yourself use different varieties of credit products to prove that you have that capability. And then also 10% is how much new credit do you have? So this is primarily only a negative factor, meaning you have a whole bunch of new credit. Again, it makes you look credit hungry. That it starts to make them ask questions about risk, like why are they applying for all this new credit right now? Are they in some kind of panic mode? How are they going to manage it over time? So, like I said, this is related to that length of credit history, but have your credit and then keep it. That it can be paid off, just to make that clear, just to clarify that point. I don't mean keep it and pay all that interest. I just mean keep the account and let it age. There are things that do not go into your FICO score. Any demographic information, your race, your color, your religion, they are not allowed by law to factor that into the score. Your age is not factored into the score. It's not different because you're 25 than when you're 65. Your salary, your occupation, your title, any of that is not in your FICO score. Now, that doesn't mean that the lender won't want to know that stuff. The first question at the top of the loan application at the bank is how much do you make per year? So the lender wants to know, but it's not in your FICO score specifically. Where you live, it's not different because we live in Virginia than Colorado. The interest rates on the accounts you already have. Your rent, unfortunately, much to a lot of folks' chagrin, they're like, well, I'm paying all this rent. Shouldn't that prove that I can make a mortgage payment? But unfortunately, rent does not factor into your FICO score. There are some special programs where you can get rent reporting, but it's not common yet. Your child, your family support, your alimony, things like that, unless they become delinquent. If they become delinquent, they are reported as delinquencies. So you don't get credit for paying those, you're just expected to pay those. Your non-credit banking information, so your deposit accounts, They're not on there, your checking account, your savings account, things like that. And then those soft inquiries, those consumer disclosures, those promotional inquiries, those are not in the FICO score. Another really common question on the personal side, what's a good credit score? What do I need? What does it need to be? And that's a big old fat, it depends. Obviously, the higher, the better. If you can get it, up over 750, 800, that's super prime. It doesn't get much better than that. Um, but you'd say, 700 and below, you're starting to talk about prime, and then down below in the mid 600s and below, you're talking about subprime. Um, and then below that is where the risk really starts increasing in the eyes of the creditors. So it's going to depend on that product, the risk appetite of the financial institution, how much you're applying for. You might be able to get 2,000, but not 20,000. But the higher the better is a good rule of thumb. But there's no one fixed, hey, I'm there, that entitles me to X amount of credit. That's your FICO score is one piece of the puzzle. That is one number that they calculate into the formula. So a little bit about delinquency and rehabilitation. The important thing to remember about all credit, this is both personal and business, is that it's data. So if the data changes, the outcome changes every time. There's no emotion to it. There's no wondering, will this work? Better data in, better data out every time. It's not like I liken it to exercise where you're kind of like, is this working? There's no really way to know until you get to the end of it. If you take positive steps, it will improve. But what that means is that you must take positive steps. Doing nothing doesn't create positive action. So that means you need active trade lines. So resolving derogatory accounts alone will not improve your credit. So the life cycle of that is, so you have your active, in good standing accounts. Those are current on-time accounts. You might refer to that as healthy debt. It's also any debt you've paid off successfully in the last 10 years. So you paid off your car 6 years ago. That's sitting there as a positive mark on your credit report. The next category is it's late, but it's active. Now, the important thing about these is that they can be made current. So you're 30 days behind, you missed last month's payment, you pay last month's and this month's, you're caught up. That late account moves up into that green category. Great. The important thing here is that with any late account is to revive it before it's what's called charged off. That means the creditor has charged it off their books, they've taken it as a loss. They said, we're not going to be able to collect that. And so they may send it to their collections department. They may sell it to a third party collector. They may sue you for it. So these, once they enter this category, they can never be made active again. It can never be a positive credit trade line again. That doesn't mean it's the end of the world. They do age, and as they age, they have less impact, but it can never be made a positive credit action again. So it's important to catch them in that late category and return them to active before they enter that charged off category. Now, there is a timeline to this. So there's a very important date called your date of first delinquency. This is mandated by law. This is 30 days after it is late. So that's when it becomes delinquent. Now, the date of first delinquency on your credit report never changes unless you bring it current again, and then you become delinquent again. But then that's a different delinquency. It's going to have a different date of first delinquency. Your date of first delinquency locks in and does not change, and then it stays on your credit report for 70 years from that date. So, September 2020, 7 years from then is when it will, what we call, fall off the report. Now, sometimes people confuse the date of first delinquency with the statute of limitations. The statute of limitations is how long the creditor has to sue you for the debt. So it varies by state. This is legislated by the state. In Virginia, it's 3 to 6 years, depending on what type of credit it is. Now, the statute of limitations does reset. So if you acknowledge that debt, you make a payment on it, you do a workout on it, you do a settlement on it, that resets the statute of limitations. They have a new 3 to 6 years to sue you for that debt, but the date of first delinquency never changes. There's one notable exception here: bankruptcies. A discharge bankruptcy, that's a bankruptcy that went through, stays on for 10 years. So it will show on your report for 10 years. There are a couple of tools to manage your personal credit. Credit alerts and freezes. Alerts are where when somebody applies for credit through that bureau, they contact you directly. You'll literally get a phone call and say, is this you applying for this credit? And you'll approve it or not. And then a credit freeze is where you freeze it and nobody, including you, can apply for credit through that bureau unless you lift it. So if you need to go, buy a car, you have to go online and lift that freeze for a period of time in order to apply. This is all legislated by a couple of pieces of federal legislation, the Equal Credit Opportunity Act and the Fair Credit Reporting Act. Those are the major pieces of legislation that tell the personal creditors how to report it, on what frequency, the data that they have to report, and to whom. So that's the baseline for how we look at business credit. So your personal credit is attached to your Social Security number. Your business credit is attached to your employer identification number. Now, especially when you start on the micro enterprise level, most business loans will still require a personal guarantee. That's a legal promise for you personally to repay the business's debts if the business is not able to make those payments. Now, most micro enterprises are going to ask for a personal guarantee, especially startups. So you want to go out there and you want to start your coffee shop. Your business has no credit history. So they're going to ask for a personal guarantee. We ask for one. Many loans by law require them. Any SBA loan, anybody who has at least 20% stake in the company must sign on as a personal guarantor to that. And your business loan, if it's a true commercial business loan, may or may not appear on your credit report. So we'll talk a little bit about why that is. That's even with a personal guarantee. It depends on how that particular financial institution codes it and categorizes that product. They may choose to report it to your personal credit or not, depending on that financial institution's policy. So the key differences here, the biggest one is that on the business credit reporting and scoring side is there are no regulatory standards. Maybe not no, that's probably an overstatement, but there are fewer regulatory standards. Everything I just went through on the personal side is mandated by law, and it's been worked out over 75 years of the history of credit cards. Business credit is much more pay to play. So there's no free reports. You're not entitled to one every 12 months. Those delinquency timelines are set entirely by the lender. The delinquency can be as early as 1 day late versus on the consumer side, it's 30 days by law. Now, the same principles apply. Pay on time, pay as agreed, assume that all defaults get reported, and review your information to make sure it's accurate. All of that still applies, but how they report it is going to be a little bit different. On the business side, these scores and models are proprietary. So they are a for-profit business. So they're pay-to-play experiences. And yeah, we'll talk a little bit more about that in a minute. So when you want a commercial report, your business is established, or you're trying to establish business credit, those commercial reports come from some a little bit of crossover with the personal world, but also one kind of a big, very known one called Dun and Bradstreet, or D&B sometimes. Experian and Equifax also have commercial reports. TransUnion does not. They only do personal credit reports. Now, these scores range from 0 to 100. And each one is a little bit different. Dun and Bradstreet calls theirs Paydex. Equifax calls theirs Business Payment Index. Experian has Credit Ranking and Telescore. So there's a lot more flexibility here. Each of these agencies also has its own criteria for what it takes to qualify for a score. So they might say it's the number of business trade lines you have. It might be the length of history your business has. They get to set those for themselves. You have to subscribe to these. So the service for your small business at this phase may be cost prohibitive. So you may want to pick and choose your investment based on the timeline. So what I mean by that is subscribe for a window of time when you have a specific goal. So, I'm trying to get, buy a big warehouse. And so you subscribe for those 6 months. That doesn't mean you have to stay subscribed to the commercial reporter forever. Also, anyone for a fee can review your commercial report. So on the personal side, there are lots of regulations around that. We have to get very explicit approval from the consumer to pull your credit report to review. If you come in and apply for a loan with us, for instance, anyone who's willing to pay the fee for your commercial report can. They can go in and review your report if it's in their company's interest to do that. Now, there's something called a DUNS or DUNS number, Data Universal Number System. This used to be the number that you needed in order to bid for government contracts. That was your identification number, and it was through Dun & Bradstreet. You no longer need a DUNS number to do that. The government contracting programs now has their own numbering system called the Unique Entity Identifier, or the UEI. So that's why I bring up the DUNS number. A lot of folks think, oh, well, I have to have a DUNS number in order to bid on government contracts. Not anymore. There are now proprietary numbers for the government contracting service. The big thing here is that Another big thing here is that these commercial reports are summaries. They're not specifics in the same way that personal reports have. So it's your business's identification info, your business's credit history. It does not include the name of the lender or vendor. So you have a line of credit at Office Depot for your business. That's going to show up as something like Office Supply Store, as opposed to naming Office Depot or Staples or whatever. They use a term in commercial reporting called slow pay. Now that might mean that you're past due. It might mean you're delinquent, or it might mean you're a habitual slow pay. It can have a range of definitions. They may report your balance, your amounts, the due dates, but they vary widely. Again, it is very much up to the creditor when you're on the commercial side. They may choose to show your current balance, or they may choose to show your average payment, or your highest credit ever extended, or your contracts. So it can vary widely. Your commercial report also shows your legal and public records. So remember, on the personal, it was bankruptcies only. On the business side, it's going to be any UCC filings. So that means anybody who has a lien on your business assets. And it's good due diligence of any lender to put a lien on your business assets to just be on the record as a lender. But it's also going to show bankruptcies and also show liens and judgments and collections. So they're going to show the full gamut on a commercial report. And then also your credit inquiries. Obviously, that's the number of times, not just that you've applied, but that a creditor or an interested party has viewed your business credit report. So the hard inquiries are applying the software account monitoring. Again, how long they stay on this one varies. It's mandated to 2 years on your personal side. It can vary on the commercial side. Now, what's not on the business credit side is your personal information. So your social security number, date of birth, that stuff, your personal credit accounts, the financial statements of the business, the P&L, the balance sheet, things like that, your cash flow. Those aren't going to be on the commercial report. Your business banking information, so those deposit accounts, things like that. Now, an underwriter, if you go in to apply for credit, is going to ask for that stuff. They're going to want your business bank statements to see all that, including us. So let's take a brief look. I'll kind of glide through these credit products very quickly because we've got about 15 minutes left. But some basics. So your business credit card, these are very, very common. These are a really good way to get started to establish business credit is get a business credit card actually in the business's name. So it's Justin Lewis Services LLC right there on the card. Vendor credit, business loans, and lines of credit. I'll talk a little bit about each of these in kind of ascending amounts. So, uh, or rather, ascending cost. So, your term loan, that's your cheapest credit, okay? And the reason it's cheapest is because it goes through more due diligence. They review more documents, they look a little bit deeper into your credit and your financial history. You go to banks, credit unions, community lenders like us, or revolving loan accounts. Um, this is sometimes you get things like SBA or SBA backed loans. Those can have a pretty narrow criteria. A term loan is typically going to be for your large purchase, your property, your startup expenses, a project that won't pay out until the end of the contract. It's important with a term loan to match the term to the purpose. Example here is you don't want to pay for seasonal inventory, so something you're going to sell in the next 3 months for 5 years. That's not matching the term of the purpose. The value of that falls off very, very quickly. Next up in cost is your line of credit. So you have what's called a draw period and a repayment period. Draw period is where you can pull down on that amount and you can actually pull it down in cash. So this is if you need to make payroll or you have certain vendors you have to pay in cash. And then at a certain point, it locks in and it becomes a term loan, and you repay it like a term loan. So that's when the repayment term or repayment period locks in. These draw periods can be many, many years. I have a line of credit for my business right now that's a 10-year draw, and then it'll lock in after that. These typically have no grace period, so they start accumulating interest right away. You pull down the money today, interest starts accumulating today, as opposed to waiting until the next billing cycle. These are advantageous to large volume inventory heavy businesses. So retail, a lot of time, food service, when you need to smooth out that cash flow. Like I mentioned earlier, you've got to pay a vendor today, but that invoice doesn't come in until next week. You ultimately have the money to pay for it, but just you're bridging that gap. Next up in cost, your vendor credit. So this is directly with the vendor. So there are two types here. There's your invoicing, where they say, you bought this, and then we send you an invoice at the end of the billing cycle, and then you have 15, 30, 45 days to pay, whatever. The longer, the better on that for you. So mechanics work this way. They order the parts, and then at the end of the month, their supplier says, okay, these are the parts you bought this month, and then you have your 30 days to pay that up. And ideally, you collected that from the customer at the time that the customer paid. But then there's also financing. So it's financing directly to the vendor. So large equipment companies, Kubota, you finance directly with them, or CAT or somebody like that. These are best for long-term relationships. Your business needs to have a relationship directly with the vendor, but local vendors typically are less likely to report to the business bureaus. So your large national distributors may do that, but it carries a cost. So if your vendor is food supplier ABC down the road, they're likely not reporting to the bureaus. And then next up in cost are credit cards. I mentioned these at the top. They come in the form of corporate cards, store cards, your just standard business card when you walk into a bank. These are best for regular cyclical expenses that you can pay. Your business has the money to pay for, but you don't want to chase down every transaction. So you have parking fees. You have this is essentially what a fleet card does. If you have 10 vehicles for your maintenance techs, you don't want to have to issue an invoice for every single time they buy gas. That's essentially how that works. Is you're paying it all when the statement hits. You're not living on that credit card. It's very expensive, but it's a good way to manage those, and it's a good way to establish your business credit. Now, any of these can be secured or unsecured to collateral. Secured is always cheaper, of course. But remember that business assets are to a creditor, to a lender, weak collateral. They are worth a lot more to you than they are to the creditor because they would have to pay somebody to go down there and you're a florist and or whether they're going to collect your pots and your vases and your used plant snippers like that's and then auction them off. Like how much are they actually making in the end? So just keep that in mind. Is you'll usually need stronger collateral than that. But sometimes they do contribute what's called emotional equity. So even though there's not a whole lot of real world value, it demonstrates that the borrower has some buy-in and that they're sharing in the investment. And then notably, you can't use credit for all expenses. So your taxes have to be paid with cash. You can't pay taxes with credit. Your vendor, your specific vendor may require wire transfers. But the vendor we use for the business I run with my wife, they only take wire transfer. So we can't put that on a credit card, for instance. So keep that in mind. Now, where you're going to go to look your banks and your credit unions, vendors, nonprofit and community lenders like us, CDFIs, licensed and reputable online lenders. That's very important. Not all lenders are created the same. And so you want to make sure that they're FDIC insured if they're a bank, and that the terms are very clear and that they're made clear for you. So I have one last little section here on how to prepare for business credit, but I'm going to pause because we've got about 10 minutes left and answer questions on that section, or on everything, because that's really the meat of it. But I want to make sure we leave plenty of time for that. So Allie, if you'll jump on and we'll take a look at some of the questions. And then if we have any extra time, we can get in and we can do a little session at the end, or we can come back for a part two. And I would love to see you all again.
Perfect. Thank you, Justin. So our first question is, it used to be bad to have a lot of open credit. Has that changed?
Open, um, uh, wouldn't be the term I would use. What they would, I talked earlier about credit utilization. They want to see you have available credit. So they do want to see you have it, but not use it. So it is a myth that people think that you have to have a balance on your credit card from month to month for it to count towards your credit. That is not true. In fact, I don't advise anybody carry a balance on your credit cards of any kind. But using that credit card just enough to keep it open, but at zero, that builds your credit very, very much over time. So, because it's showing that you have available credit. So they don't want to see you close everything down because that looks like you haven't managed anything. They have no performance history to base that on. So yes, as you go, you want to extend how much you have available, but you don't necessarily want to use that. Does that answer the question?
I believe so. And as
Okay.
a related sort of follow-up question, someone asked, if you have no credit, how much should you get and when to avoid looking credit hungry?
Yeah, that's a challenge for everybody, especially young people. And then also we serve a big rural clientele, folks who just, they grew up with the mentality of like you pay everything in cash. So you have, somebody who every truck they've ever bought, it was, $35,000 in a wad, at the car dealership. So um, there's no one right answer. But the biggest challenge when you have no credit is going to be establishing the good quality credit as you go, and then building on that. So they're not going to let you jump into $100,000 loan. Like there's no creditor who would give you that. We wouldn't give you that if you've never had credit before. So the way I started, and this is just purely anecdotal, this to use as an example, is 20 years ago when I was new to credit, I got a secured credit card, which is where they use a deposit in the bank as collateral. And it was little, it was like $250. That's all I could get at that age. But over time, you demonstrate positive credit habits, they lift the security. And all of a sudden, you have just a regular credit card. And then over time, you request that credit limit to go up. And then, you have a year of positive credit habits, and then now you've got $1,000 loan. And then it's up and up and up. And then you need to go apply for your auto loan and you try to so you have to do it, you have to step up. You don't want to take a big leap. And then what you want to do as far as credit hungry, thank you for using that term, is you don't want to go in and apply for a whole bunch in a row. Don't go get 8 pieces of credit at a time. Go get one good quality piece of credit, pay on that. All right, a few months later, go in and get another one, or more than that, because it's all building up over time. So yeah, that's what I. There's no one right answer, but I would take that approach.
Thank you. Next question is, if a business is terminated, what happens to its credit report? Do the commercial reporting agencies need to be explicitly notified of the termination, or do they get the termination information from the State Corporation Commission?
That's a good question, Carl. That I've never gotten that one. And I don't know if I know the explicit answer to what happens to the credit report on the business side. I do know those debts don't evaporate. The debts are going to fall to whoever is legally liable. That's what the personal guarantees are for. What I would imagine is people don't bump into that a whole lot because if the business is gone, they're not applying for credit anymore. So there's no reason for somebody to pay for that inquiry. Um, so that's a good question. I can say I don't have a definitive answer to like, does it evaporate or what happens? I'm not sure, Carl. Great question.
Next question. Would opening a mortgage loan have any impact on your business credit score?
Only if it's opened in the business's name. So you have established business credit. And that's typically usually you have to be pretty scaled up by then. Manufacturers a lot of times have credit in their name and they bought the warehouse and it's like the business owns the warehouse. But a personal mortgage would not. So your personal credit information is not on your business credit report at all. It can go in reverse though. So depending on, so if you get a business loan with us, it is a business loan. It's an SBA microloan, let's say, and it is in the business's name, but we have a personal guarantee on it. We report those to the personal credit bureaus. So that would show up as a People Inc. Financial Services loan on your personal credit report. Um, but as far as the inverse, no, that doesn't. That your personal mortgage, if it's in purely your name, would not be on the business credit report.
Thank you. Next question is, if I have more than one business, can I apply for a loan for each business?
Yeah, yeah. So another thing about business credit is so your personal credit lives with you forever. We all have our one social security number that we're assigned at birth, and we have that forever. A business, one of the advantages also of establishing business credit is that it goes with the business. So if you exited the business and sold it to somebody and they had established business credit, that credit would stay with the business rather than go away with you. Um, so yeah, so if you have each of those businesses has the qualifications to have business credit, yeah, it would live with that identity. The one thing sometimes folks think, oh, I'm going to get business credit in order to sidestep my personal credit, and just a business that's never existed before, that's not going to be possible. They're always going to look at the founders, the owners, the investors, whoever it might be, to personally back those loans until the business has credit history.
Wonderful. Next question is, we recently tried to apply for a business credit card and the bank told us we needed at least 10,000 in our business bank account to qualify. Is that a standard requirement across banks? And are there legitimate ways for new businesses with little or no capital to qualify for business credit cards?
That's a great question. And one of the classics, like you need credit in order to get credit. Um, no, it's not standard. Every financial institution can set their own risk criteria. And that's one that business, like that's a signifier to us that a business is ready to take on credit. Um, but what you can perhaps do is scale down the request go with a different bank. Here's the thing to remember about all banks and all lenders is banks are for-profit organizations that are in competition with each other to compete for your business. You're buying a product. So this one bank has terms that don't fit with you does not mean that the next bank doesn't have a different set of criteria. Oftentimes, a good way to approach it on the micro enterprise level, you're a person working for yourself, um, is smaller banks, community banks, regional banks. because then you can have a relationship with the banker. If you just go down to Wells Fargo, and this is nothing against Wells Fargo, they're also a great bank, but they're really big. So they just plug things into the underwriting formula. If it doesn't fit, it doesn't fit. Smaller banks, sometimes there's a little bit more ability for the human touch to be able to communicate, hey, I'm just getting started. Is there something responsible we can do, et cetera, et cetera. Another way, if you're looking to just establish business credit, is to take out a small, manageable business term loan that is in the business's name that you personally back. And you know that I'm not saying take out unnecessary debt. That's never the advice, but that could be another pathway.
So we have kind of a follow-up question to that.
Mhm.
If you could give some examples of steps to follow to get a credit card, things like buying office supplies for $50 for 2 months and applying afterwards, that sort of thing.
Where are you seeing this one? Okay, so is this the Catalina one
No, this is
question?
one that I thought would get
Okay,
answered in the question you just answered, but the responder or the asker asked to reopen it.
sure. Can you state the question to me again?
Yeah. Can you please give an example of steps to follow to get a credit card?
Mhm.
For example, should a business owner buy office supply, $50 of office supplies for a couple months and then apply?
Mm. The the just like on the personal side, it's going to be that stair step approach. So basically, when you first start, it's going to be getting what you can get. So it might have a really low limit. It might be like our previous asker said, "Hey, this bank needed a $10,000 deposit before I could even get one." Um, the you can also there are also business lines of credit. That's what I have with my business. I don't have a business credit card, but I have a business line of credit. So that's through a regional bank down here. Um, the important thing about credit cards, this is not universally true, but it is widely true, that if you pay the full balance by the due date, then you pay no interest. So there's what's called a grace period. It is required by law to be 21 days, no less than 21 days. And basically, what that says is from the time we generate the statement to the due date is at least 21 days. And in that time, the statement is exactly as printed. It cannot change, which means if you pay it down to zero by that due date, you effectively gave a no interest short term loan to yourself. That is, in my view, the most responsible way to manage a credit card. So if you're trying to establish positive credit habits, we were talking about active trade lines, which sounds like what you're talking about. What I would do to demonstrate positive credit habits is you have it established, you make a routine purchase that you would make anyway, and that you have the funds to pay for. That you're not buying more than you could pay in the first place. Doesn't have to be a lot, just has to use it to keep it active. And you use it to buy that tank of gas or pay that utility bill or whatever. And then you pay it off in full as soon as you get the statement. And then do that just routinely. Sometimes on the personal side, you might just sync one of your standard monthly bills to it. My water bill just automatically hits my credit card and then I pay it off. The big thing here is never pay it late ever once, not one time. And then the other thing is um, uh, to over time apply for more. So, hey, I had a $500 card. I've demonstrated for 6 months that I can use that and I pay it off in a timely fashion. Um, oh, the other thing I was going to say, and never carry a balance, because if you carry a balance, that's when that 25% interest kicks in. And you don't want to do that. So pay it off in full over several months. Ask to increase the limit. Don't use it anymore. Use the same exact amount, but now you've increased your credit utilization. So now you have $1,000 and then 2,500 and then five and then whatever. I've in the past asked to increase my credit limit just to have it increased. I don't use and this is on the personal side, but I don't use it anymore. I just have a wider utility. So as you do that, then it starts to show that you can handle more credit, that that you can manage it responsibly. Then, as you get along the road after you have that, that's when you start to say, okay, I'm going to go out and I'm going to try to get an installment loan. Or I'm going to try, and I'm going to go out and get a piece of equipment. I'm going to establish that line of credit. So again, it's a stair-step model. The last thing you want to do is walk into a place like PIF's and say, I want $80,000 to put into my business. Unless you have tremendous personal capacity to repay, which some people do, that's a big stretch. And so, but if you step it up and say, okay, I went from the 500 to the 1,000 to then I got the line of credit, and then that built, and then I got the installment loan, and I paid that off. I paid that off early. All of that starts to build up that credit history.
Excellent, thank you. So I do note that we are at time, but we do have some availability to answer some more questions. Justin, if you're free to
I'm
stick
down,
with
yeah.
us. All right, so folks are welcome to stay on and we'll try and get to a few more questions.
These are great questions, everybody.
Yeah, so follow up to the last one that we talked about. If you have a good credit score but have heavy utilization, say 55% on your personal credit cards, making it harder to open a business credit card, what would
Mhm.
be the best steps?
Uh, I would try to improve your debt to income ratio. So pay down those balances as much as you can. Um, there is an intersection of the behavioral element. You have to know how you personally are going to manage it too. So if asking for a whole bunch more credit is going to be a risk factor for you, don't do that. If you're trying to quit smoking, you don't sit with a pack sitting right in front of you all day. But pay down the balances, and as that improves, and as your credit performance improves, ask to increase those limits. So that starts to kind of like you get the double effect of paying down the balance and increasing the limit, which is going to compound that utilization. So, and then once you get that down to below 30, then you're in the really healthy range, and your score is going to start to reflect that too. The score is going to go way up, unless there are other factors. And another important thing to remember is that business debts cannot be taken out to pay for personal expenses. That is an instant disqualifier in our policy. For instance, we are not permitted to give out a business loan to refinance personal credit cards, for instance. So that's a little bit when I first started talking about that, how the way to start building for your business is to start working on your personal credit. That's how that intersects right there. So um, you can't solve every credit issue by tomorrow, but you can start like right now. It can start right now, and it can have massive effects on your ability to borrow 2 years from now.
Good to know. So next question is, what if you accidentally applied for a credit card with a high limit and don't really need the card because of the high interest rate? What should you do?
So this all depends on whether there's a fee, whether there's an annual fee, or semi-annual, or whatever, a periodic fee. If there is a high interest rate, but there's no fee, well, 25% or 30% of zero is zero. So in that case, just don't use it. Just cut it up. Just let it be an account that you don't use. Um, if it has a fee, you may want to close it down, which is, and basically what you're doing there is just upgrading. So like I said, best practice is not to close out credit, keep it open but unused. That's basically what you would do with a card that you don't love the terms on. And so the only thing that's really going to be onerous is a periodic fee. So if there's that, close it out and get one that doesn't have a fee. There are loads and loads of cards that have no fee. Um, but if it doesn't, just sit on it and don't use it, because zero, 100% of zero is still zero. So as long as you don't carry a balance of any kind, you won't owe any interest.
Next question. If the business is going to be an LLC to protect personal assets, how does credit work when you don't mix personal and business?
Um, so an LLC has the veil of liability, typically legal liability, and it does protect your personal assets. But like I said, on the micro enterprise level, they will typically ask you for a personal guarantee. So that's where you're saying that, and that goes around your LLC. So because you're signing, you're saying, I, Justin Lewis, am responsible for this business's debts if the business can't pay them. Um, and that's going to be true until your business is established and has its own credit history, which, like I said, typically takes lots of revenue and time. Um, so it's also important to remember that a single member LLC for tax purposes is identical to a sole prop or self-employment income. So it's just the same for tax reasons. It's exactly the same as your self-employment income getting a 1099 from somebody. So that is completely unchanged. Um, so basically what the LLC does, and I'm not a legal expert by any stretch, the Capital Pathways can help plug you into one to get some actual legal advice on this. But from just based off my experience as a small business educator, is that it gives you they can't somebody if your business were to get sued, they can't sue you for your personal assets, if that makes sense. So that's where the veil comes in. It's not I signed for this debt and my business is responsible for it, and so therefore I'm not. That's not going to be how it works for at least a small startup business.
Excellent. All right. So some credit cards provide FICO reports monthly or quarterly. Does that affect a person's credit score? If so, or if they go to the annual report website to pull the one time every 12 months, their report would, sorry, I'm having a little bit of issue reading this question. Some credit cards provide FICO reports monthly or quarterly. Do those reports affect a credit score? If the person goes to the annual report website to pull the one time every 12 months report, would that conflict with the credit card reports?
Great question. So that is a benefit that a lot of financial institutions will provide. They'll say one of the features of our website is that you can see the credit report or score or both that we use. So they'll say, I have a few of these. So I have a Barclay card and they say, hey, we use the Vantage 8. So you can see your Vantage 8. Remember back when I was talking about credit scoring, that there is no one score. So my Vantage 8 doesn't mean if I went down here and applied at Pioneer Chevy down the road, they might not pull my Vantage 8. They might pull my Experian Auto 4. Who knows? But that's like a bonus. They can say, you can see what we see. And does that affect your credit score? No, not at all. You can go on there and that's just a feature. What the creditors and the banks have learned is that it sets people up for success to be able to see that information. And so, actually funny you should ask, all three bureaus, so Experian, Equifax, and TransUnion, in 2023 determined individually as companies that they were going to give access to their credit reports once per week. So I stated you're entitled to it by law once every year. But the bureaus each individually make a report available weekly at no consequence. So it does not affect the report. Those are soft inquiries. They're for information purposes only. As long as you get them from those accredited sites or you're looking at that glimpse on your credit card app or whatever, those are for information purposes. And it's because they've learned people pay on time more. They end up applying for more credit, probably that's because that's ultimately the bottom line. So that's a great question. But no, yes, that can be a feature. The important thing to remember about those little features that with your bank or your credit card is that that's typically going to be just a limited glimpse. That's going to be the one they use. And so it's it's your Experian, whatever. And so to get the complete look, you would want to go in and pull from all three bureaus and review them all individually. If you're going to make a major investment, like trying to get a business loan or buy a house or something.
All right. What business credit cards are the best? Ones for travel miles, cash back, etc.
That's one that I do not endorse any particular product of any kind. And also frankly, it's a big old, it depends question. It depends on your needs, your business's needs, your personal needs, what you can get. where you are in the life cycle of your business, what rewards you would benefit from. So you will have to navigate that for yourself. There are a couple of resources. There's one called Compare Cards, and one other that I can't pull off the top of my head, but you can do, oh, Bankrate, that you can look at terms side by side. But I've also found, for me at least, kind of mid-sized banks and smaller, not necessarily community banks, but more like mid-sized and regional banks have really excellent credit card terms. So I would look there too. Don't just look at the big banks.
So would you say the big banks are the same as the business credit bureaus?
No, no, big banks. What I mean by the big banks are like Bank of America, Wells Fargo,
Okay.
those are the big banks. Those are Capital One, those are the big credit card companies. But I also have a Visa card with the credit union that I bank with, and it's got really great terms, like much better than I could get from Capital One or Wells Fargo or whatever. So I was just saying, also look at your mid-size and regional banks for credit products. The bureaus don't issue credit. They don't. They track the data, the credit data, and then sell it to creditors, but they are not creditors themselves.
Okay. So next question is, if you buy a business, do they check the new owner's credit score when applying for loans, or can you pass that with the business history?
If the business
Or
has a credit.
bypass that? Yeah.
Yeah, yeah. If the business has an employer identification number that has a credit history attached to it, and again, like I said, it's going to vary a lot based off who the commercial bureau is, because they each set their own standards on the commercial side. Then it would go with the business. And so but theoretically, those businesses would probably be a little bit more established and have maybe a board of directors or have some kind of governing body. And so you're probably going to be an officer of that company in that case. So you're the CEO or the COO or the CFO or whatever. Um, that's kind of really going off the deep end on that. But no, theoretically, if there is established business credit, then they would look at the business's credit history. And they would be separate.
All right. Um, how does someone subscribe to get their business score and keep track of their business credit report?
You go to those bureaus and you would go and subscribe to their services through them. They are for-profit organizations. So if you go on Google, Microsoft, Bing, whatever, that you would be able to go on there and do that um, from there. Um, I'm gonna pull my screen down. Great.
All right, we have a few more questions, and I think I
Done.
may close the Q&A in the interest of time. So in working on personal credit to establish business credit and not closing accounts, is there such a thing as too much credit?
There's certainly such thing as too much debt. I don't think there's too much credit. If you're managing it well, there's no upper limit on that. Because that's ultimately, if you think about buying a house, you're eventually trying to get a loan for, $250,000. That's a much bigger loan than they would give me as a personal loan. But you have to take that in the context. That's a less risky loan to the bank because they own my house. That's the security for that loan is my house. So if I were to get hit by a truck tomorrow and couldn't repay it, they still have possession of the house. They could sell that house and recover the debt is the idea. Um, so as far as, is there too much of responsibly managed credit? No, I don't think. I wouldn't. That's a bit of a judgment call, but I would say no. But there is definitely too much as far as carrying balances. There's absolutely a limit to that. It's like, oh man, this person has 18 credit cards that are all maxed out. Like that starts to say something in your credit story, and just start to affect the figures as well. Um, so you can certainly be over leveraged if we're talking on the business side. Okay, well, this business just bought a warehouse and then they also have this line of credit that's just entered its repayment period that's maxed out, and they also have that, and they also have that. And managing that debt is a big part of managing a big business is that debt schedule.
If there is a fee on the zero credit balance with a high interest rate and the person decides to close it out, wouldn't that impact their credit score, especially if the credit limit is on the high side?
Yes, it would impact the credit score. If it has the fee, depending on your particular situation, because it's another big fat, it depends. It may be worth it in the exchange. So if you're like, okay, man, there's this $100 fee on this card that I got when I was younger because I couldn't get a better card or whatever, or I just, maybe lived and learned. Um, for me, I wouldn't want to carry a fee on a card unless it gave me great rewards. So, airline miles that are really valuable to you or your business, or um, a lot of times it can help you rent hotel rooms and cars and stuff like that when you're traveling. So that would be the only way to counterbalance a fee. And so what I would do in that case, if you're trying to say, okay, well, is this going to affect my credit score? Yes, it will, because it'll be taking down that ultimate availability. But you can replace that. There are absolutely good quality credit cards that carry no periodic fee of any kind. And so if I were in that situation, I'd say, okay, I don't want to carry this fee anymore. I would try to increase my availability elsewhere and then close that one out entirely. That would be a bit of a trade, though. So great question.
Alrighty. So I think we're down to our last few questions. What is the best way to use the new MyFICO service? And is there a way to stop soft inquiries?
So to speak to my FICO, I am not familiar. I don't work for FICO, so I'm not able to speak to that. But as far as stopping soft inquiries, there is not. The important thing to remember about soft inquiries is they have no effect on your credit score whatsoever. They are purely informational. So they might be promotional, they might be for consumer information. You go on to annualcreditreport.com. That's a soft inquiry. You have a creditor, and you have an existing account, and they go in to say, how's Wanda's credit looking? So that they can upgrade and downgrade your account in their profile or in their portfolio, because they're trying to manage their own risk. They have no effect on your credit history whatsoever. In fact, when everybody on this call goes and pulls your credit reports, you'll see at the end of them the inquiries section. And there will be hard inquiries. If you haven't applied for credit in the last couple of years, there will be none. Every time you have applied for credit, they'll be there. Hopefully, it'll be a handful. And then under that, there will be dozens and dozens and dozens of soft inquiries. And they are purely for informational purposes. So there's really no reason. You don't need to stop them. They have no impact on your credit, your actual credit score at the end of the day. Can it be a nuisance to get credit card offers? Of course, but that's the credit environment. So we're all there on that. I go, there'll probably be a couple in my mailbox today. So, but rest assured, if it's truly a soft inquiry, has no effect. If you're seeing, though, one of the things you want to look at when you review your report is make sure all of the inquiries are legitimate. Especially the hard ones. Like, did you actually apply? It'll say ABC Auto on this date. It won't tell you the amount, but it'll say where it was and with whom and what kind of credit it was. Did you actually apply for that? If not, you might be dealing with some identity theft, some credit fraud. So if that's the case, you need to freeze your credit right now. I just live with my credit frozen because our data is everywhere. Everybody here on this call, your data has been leaked at some point in the last decade. All of it, like your social security number, all of it. So it's out there. It's just whether the fraudsters have found it and made use of it. Not trying to be chicken little on that. It's just something, it is part of the modern world. There's a big data industry. So I live with a credit freeze on. And then when I need to apply for credit, I lift it for a period of like 2 days, and then it freezes back down. I think we got one under the wire question, Allie.
Let me open Q&A back up.
I can read it. It's from
All right.
Anonymous. If two people use a credit card, each person has their own credit card under the same credit limit. Is the spending applied to both of them or just the primary holder account? I ask because there's one credit card that my ex and I have, and if we close the account, that would hurt mine and her score. Just trying to be mindful of timing and see how to manage that. Yes, it goes to all the authorized users. In fact, that's a way that a lot of folks establish personal credit is maybe they have a kid or a partner or somebody who needs help establishing credit. A way to start is by becoming an authorized user on somebody else's account. So they might not even have a card. You have your 15-year-old kid and you put their name on your card, basically. You don't even give them one. Every time you're using that, they're building credit history. In fact, that's how I had to get my first credit card. My wife, my now wife, had to co-sign with me on like a Best Buy card. It was just like it was just the card I could get. Um, and she actually co-borrowed with me on that one. But that is another way that folks go about it, is become an authorized user on somebody else's account. As far as the X, getting your finances disentangled from a significant other is complicated. If you're in a place where you can communicate with them about it, that's always advisable, and say, hey, we should probably close this out. It will affect both of you as far as your availability, but if it's in good standing, it's affecting both of you positively. That's good, but I would tread lightly sharing an account with anybody that I don't share expenses with. So for my part, I would get that closed out kind of ASAP, because you just don't know what financial path they're going down, and it could have big effects on your credit if if something were to happen to the account.
That's excellent information. So we have reached the end of our time today. Thank you everyone who stuck with us through the additional questions and additional time. And Justin, thank you so much for your wonderful presentation and the excellent answers to the questions. We absolutely look forward to future sessions with you. For all of our participants, thank you for attending. The recording of today's session will be shared as part of a follow-up email that will be sent out to everyone within a week of this webinar. Again, if you weren't able to get your question in or may have a more specific question, please feel free to send us an appointment request through our website or my email, and I've dropped both of those in our chat, and we'll be sure to help you or connect you with resources that can support your needs. Thank you everyone so much for joining us, and we hope to see you all in future webinars.
Thank you, everybody.